This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro. Today's stock market update. It's Thursday, right around the close. I'm going to do this and post this up for Friday morning. One of the housekeeping things I wanted to mention is I only look at the comments section probably like once a day. And that's not that the comments for Invest Like a Pro are meant to answer specific questions about some of the videos and techniques that I'm talking about. And if I can do that in that forum, I'll do it. Sometimes they're too complicated and it's more like a one-on-one type of session that we need to do. But I am not going to give advice as to whether the market's going to, whether it's a buy right now or anything like that on that forum. That's not really the purpose of that. It's more educational. If you're a subscriber, then you can go to the RSR comment area if you want. I only look at that once a day too, but it'd probably be better if you're a paying subscriber and you want to ask me a question, you probably just want to email me. So I just wanted to make sure you knew that because I see periodically, time to time, someone will throw a comment in there saying, "Oh, is this a buy right now?" And I don't even see it a lot of times for like 24 hours later. So not really the purpose for that comment area. Just wanted to make sure you're aware of that. So I'm going to talk about the market. I'm going to go into some key things I think that are taking place today. And then I also am going to go through a specific trade setup, and I'm going to give a lot of detail into terms of the exit strategy that I would use. So let's go ahead and get into this. So I'm just going to show this chart real quick. Number one, and what I have been talking about now for the last few weeks is this sentiment number. It's the Investors Intelligence bull minus bear spread. It's down to minus 19%. That means there's 19% more bears than bulls. And I've been using this indicator for about 30 years. And when it gets this big of a negative number, you want to be on the lookout for signs of a reversal. So that's why I brought this up last week, because it was at negative 16%. And now we're at negative 19%. And we're getting pretty confirming evidence here. This was a big deal for me, right? I mentioned this. I'd really like to see this come down and touch the quarterly 18. So I've got all these 18s listed on the left up here. This red line is the 3-month or the quarterly 18. And we came down and finally reached that after failing at the 18-month line, right? So I've got all these 18s up here at the same time because they're showing the trend for that time frame, basically giving you the idea of the trend on that time frame. But they also are really good signs of support and resistance. You can see the resistance at the 18 here, and then we actually failed at the 18-day, failed at the 18-day, and then failed at the 18-day. Well, now we're bouncing off the quarterly 18 and we're coming up against the 18-day again. Let me show you a few things on the other charts that I think are important. So first of all, I'm going to switch this just briefly to a 3-month chart and show this quarterly. So look at this quarterly chart. You see how this is pulled back to the 18 and the 18 is above the 40 and both lines are rising. So we can see that we get pretty good opportunities on pullbacks a lot of times when this is coming back to this line. Now, what I don't like is this big bar to the downside. This is quarter 2, right? This was a huge down quarter and we tried to push up into that and then failed. I mean, there's pretty good resistance up here, really above 4,000, 4,200, something like that on the S&P. So that's a bit of an issue, but that doesn't mean we can't rally off this 18-month line. Now, I've talked about this over and over again. Notice how the 18-month has rolled over, and that kind of plays into what I'm talking about on the quarterly, right? I mean, like we could rally, but then we might have to come down. We might spend more time consolidating in this range. But what was important to me about this week, let's pull up the weekly chart because I put the fib grid up and we came down and touched the the 50% retracement almost to the penny. For the S&P and the spider. We hit the outskirts of support, and I was using a range between 3,400 and 3,500. We hit that, and we do have MACD making a higher low while this is making a lower low right at the 50% retracement. All right. Not a small deal. I mean, that's a pretty big deal. Now, I've mentioned this and how the ADX is not in such a great position, but we can get pretty decent rallies when we have MACD divergence in place inside the trend. We have a lot of room to get to the trend line. So we've got that in place. Now, the reason why this signal is better than last week's signal, because last week I saw momentum divergence potentially, and we started to rally off the low. We were getting signs on the hourly chart of improvement. But why is this one better? Why is this a better signal? Well, number one, I mentioned this, right? We came down to the 50% retracement. That's a big deal. We're holding that. We're showing respect for it, at least in the short term. We have momentum divergence on that time frame, but now look at what happened on this new low. We have momentum divergence on the daily. We didn't have that on this decline. This hit a new low with price. Then we rallied up and came down, had a big gap this morning, hit a new low, and this is making a higher bottom. Okay, now DI is diverging a little bit again. We've got pretty good volume action taking place. Now we're not below, we have not broken the trend line. I want to show you something. Now the trend line that I had drawn in here last week was here. All right, but now that we went to a new low, you can accelerate the trend line, because once you go to a lower low, now you can draw and accelerate the trend line. So this is the new trend line that's in place. Now, if we look at that, we're hitting, and the other thing, when you know you're looking at the right trend line, you usually have the 18 and the and also the trend line right around the same level, and they'll have the same slope. So I think that's pretty bullish from that standpoint. When they overlay like that, and when I say I think it's bullish if we can get through, because we're going to be getting through both lines at the same time. We haven't gotten through it yet, and I think the way I would look at this is we've got divergence at the 50% retracement. We're at the 18 quarter line. We've got divergence on the daily chart that to go along with the weekly divergence. And look at what happened here. This gap down also created divergence on the hourly. So we have 3 different time frames giving a divergence signal at the same time. It's pretty rare. We don't usually see that happen very often. Now, when we look at this, I mentioned last week about this undercut and how this didn't confirm, and then we turned up, and we were really close to turning things around, but we had not gotten through the 18-day. We end up failing at the 18-day, and then we come back down again. Now, look at what's happening. We're doing this undercut and rally pattern again, this time with another layer of divergence, with divergence, a new form of divergence, or a new characteristic of divergence based on this low and this low. And what I did here, and what I recommended, was going down to the 10-minute and looking for this undercut and rally pattern. So what I want to do is I want to spend some time talking about this signal. But before I leave this, before I leave the analysis side and go into the trading side, I do want to make this point. So what we want on the analysis side, what we're looking for something a little bit more meaningful, is we want this to come up, make a higher bottom, maybe test this area, and then turn up and show up on an hourly chart. And if we can do that, so one of two things is going to happen here. We're either going to break the trend line, maybe come up towards the 40, and then pull back and test the 18, which is cupping around. And that would be an interesting setup if it played out that way. Or we're going to fail right here at this line, come down, maybe test support, and then come back up through. And what's going to end up happening is the hourly is going to come back like this and turn back up. And if we get that, the thing is the reason why this would be important if this holds and this goes to a new high is because this signal here would be taking place above the 18 for the first time in this decline. We'd be getting an hourly turn above or at or above the 18-day. So we haven't had that. We also haven't had divergence on the daily chart. We've had confirming evidence on every new low. So this is a better signal. It doesn't mean it's going to work. I mean, we could be in the throes of such a ferocious bear market that all these signals just fail. That's why you don't, you throw a little caution into the wind. You don't sit there and put the whole account in the market here. But what I would tell you is if we get some more confirmation, then we should be looking for a much better rally to take place. I mentioned that last week, and a lot of that is due to the fact that we've got all this bearish sentiment. People are too negative. We're going to have to flip that around and get people to believe that they've missed the low. That when we have this much negative sentiment, that means there's a lot of cash on the sidelines right now. Everyone's sitting on the sidelines, sitting back, saying the market's going down. That's probably going to need to change before we can make a peak if this ends up turning. So we need a little bit more evidence still, but we're getting a lot closer. And look at the size of this bar. I mean, this is a monster bar. That's that reversal bar on what was considered to be bad news at the start of the day. All right. Let's go in. Now, I know what I wanted to just make mention here is that we've got this undercut pattern. You know, it's right around 360 where it's breaking below and then really getting back above this sideways line, this breakdown point. All right, so let's go and look at the 10-minute and the 2-minute. 10-minute on the right, 2-minute on the left, and I want to give a lot of detail on this. So we know the undercut started to take place right around 356 on the spider, but we know that when we look at the hourly, it was really more like 360. So it looks like, I mean, look at this. This is an undercut and rally. It's nothing like what happened the last time. So let's just take a look at what happened the last time. It turned up, and I mentioned it way down here because we were getting back above this 360 mark on the hourly, and we got back above and we had a really tiny hitch play and it turned up. All right. This time it didn't do it that way. It just took off and it wouldn't pull back. So you had to be patient and you had to wait. It finally came back, went through this process of consolidation. Now, it really looks like it's extended. But if we go back and look at our 360 mark, right, it's not really that extended. And look at the dynamics of the move, the power behind this move. Really powerful, strong move to the upside, and then we get this little pullback. We have confirmation on a MACD basis and confirmation on a DI and ADX basis. So we can play the pullback towards support. Now, this is almost like a gap up. So when you have that, don't be expecting it to come all the way back to the 18 on that time frame. Look for price support, and that's what happened here. So now let's go to the smaller time frame, and I want to give you some detail on this. So we get the move to the upside. Now we get a lower high and a lower low. Now when I have a lower high and a lower low, I know I can draw the trend line in place once these lines are starting to come together. All right, this is getting really close, and this is getting very close to the zero line. And right about in this zone, I would say in these 2 to 3 bars in here, you put your trend line in and you sit back and say, okay, I know I don't have low ADX, but what we do have is a power trend. This is amazingly strong. Huge reading up to 70 on this time frame on the 2-minute. And then during this correction, you couldn't even get red to come up and kiss the green. So I know we're looking for low ADX and zero line reversal, but this is another version of that when it's so strong. You know, the moment this crosses down below a little bit, if these lines aren't crisscrossing or kissing at all, you can take the trend line break. So if we look at that as an operative entry, which I believe is an operative entry, I'm going to take this trend line break, and I added a little slippage, and I'm going to say I bought 200 shares at 362.20. Now, just realize, yeah, that's a lot of money. You know, say for some accounts it might be too much, but on an intraday basis, you get more buying power. So it sounds like a lot, but if you have a decent account, it's really not that big of a trade. I wasn't sure exactly what to use for the example, so I figured this was good enough to give you guys a feel for what you could do. So if I'm buying it here and I have a stop underneath this last swing low, it's about $1.10 because the stop is down at 361.10. I bought it at 362.20. So if I do 200 shares, I'm risking about $220 in this trade. Okay, so that's my risk. If this fails and turns down, I lose $220. Now, the way I trade is I like to know, and I actually have in a spreadsheet like what 1-to-1 is, meaning what is one time. So I'm going to add $1.10 and see what that number is. That's 363.30. Okay. So when I get what I risk, I like to do something. So at 1-to-1, I'm going to take a quarter of a profit. I'm going to sell 50 shares of the 200, and that profit's only $55. But what I'm going to do at that point is I'm going to raise my stop to a break even. Now, what I've got now is a risk-free trade. It's an intraday trade. So yeah, there might be a little bit of slippage, but I've already taken a profit. So if this comes down and takes me out, I break even, make a little bit of money. I've made 50, maybe $50 or something like that with slippage. I have a profitable trade in place because the balance of the position, the 150 shares that are left, are at a break even. All right. Now, that's not what happens. This moves up, it pulls back, it holds the moving averages, makes another new high, pulls back again, holds the 18 and the 40, which are now rising, and then goes up to the next target, which is 364.40, and sell another 50 shares. Okay, the profit on that is double what you got on the first 50 shares. So you're up to 110 in this profit. Now, the stop moves up to the level of your first target. All right, so I'm going to put a stop wherever I took my first target. I'm going to go and put my stop. That's at 1-to-1. That's 363.30. All right, now I'm sitting back, I've got my stop here, I just took another target, and it runs and hits within another 6 minutes, you're hitting another target at 365.50. Now, you take another 50 shares. This time it's $170 profit, and that's at 2-to-1. And I'm sorry, that's at 3-to-1, and your stop goes to 2-to-1. All right, so now I've locked in, I've taken 3 profits, and on the last piece, I'm locking in a gain of 2-to-1. All right, and then it goes to 3-to-1, and then look at what happens. At 4-to-1, it got within 10 cents. It was the target was 366.6, and it got to 366.5. Now, I don't take a target there. I just keep trailing a stop, and I'm going to keep moving it. So if it went to 367.70, then I put the stop at 366.60, and I keep going until I get stopped out of the last quarter. But what happened, because it was so close, and it got that close, and it was extended, and you can see on the 10-minute it made a pretty big move. You know, you move the stop up to here. I mean, it was close enough. It's close enough. You know, if you would have hit it another 10 cents, you would have raised the stop. So I look at it like, you know, just you've got to use a little bit of judgment. And so I would raise the stop and be stopped out of the last piece at 365.50. So when you add all this together, you're making about $500 on a $220 risk, and you've done it in an orderly fashion where you took out the risk right away. You turned it into a profitable trade and then went to a break even. And then from here on, you're going to be a lot more calm about the trade because you've got a win in place, or worst case, a small, you know, like a small profitable trade. Once you get 2-to-1, you start to feel pretty good about this, and you start raising the stop, and you're realizing that you can actually make some money in this. Now, you could argue whether, you know, you move the stop or not. I mean, if you want to be exact, yeah, you would have probably been stopped out at 364.40 on the balance. But look at what happened. We actually got another setup. And this was another one, a zero line reversal, and this time it had low ADX without a lot of strength in the sellers. And you can see this setup had a new high in price, new high in MACD, new high in ADX. You would have taken this pullback, and you could have taken the next trade and done it all over again. All right, so this is the process that you go through. Now, I'm giving you this detail, but here's the funny thing that I really want you guys to learn. So all of what I'm showing you right here, I was doing on daily and weekly charts, this target analysis using this risk profile, using the original risk, and then looking at targets based on that. I was doing that for a couple of years on longer term trades, on the weekly chart and on the daily chart, and it was like, this is kind of interesting. I probably wouldn't work on an intraday basis. And I watched a guy who is a really, really good intraday trader. And this is almost the exact process he was using to book money on a daily basis using really short-term trades, 1 minute, 2 minute charts. So I was like, it was such great confirmation for me because I realized what I was doing on actually longer term trades, but the whole process can work no matter what time frame you're using. So what I'm showing you, even though I'm doing it on a 2 minute chart, definitely will work. In fact, I first started doing it on weeklies and dailies. And it's a great process to keep you consistent on the exit side. Now, if you want to use prior highs and stuff like that, one of the things that I don't like is I don't want to get long here, have a stop here, and not be able to take a target until it's at a new high. You see what I mean? Like I want to make sure 1-to-1 is below that high. That's the one criteria when I look at the price action. If I'm buying, so if I'm getting in up here and I've got to stop here and I've got to get a profit at a new high, I'm not as attracted to that trade. Hopefully that makes sense to you, but I want to make sure that I'm taking a target when I get back to this prior peak. So that's why the entry pattern is so important. All right, well, I hope this was helpful. Go ahead and post any questions or comments, and we'll see you next time.